Welcome back to the watch list. We're watching KB Home. It reports its numbers after the closing bell today. Shares have been under pressure, in fact, down 20% this year. Of course, mortgage rates have remained elevated at or near 7%, no 5%. And most folks refinanced at 4% or lower. So they're not moving too quickly. In the meantime, our panel is ready. Melissa Armo, founder, owner of the stock Swoosh, and Michael Singleton, senior analyst and principal Invictus Research. Good to see you both. Melissa, I'll start with you. These home builders, KB Home in particular, are you expecting anything good out of this story today?
I don't know what they're going to say today because they lowered guidance the last earnings back in March. And like you mentioned, the stock has taken a tumble. Started the year over 70. Last earnings, it dropped. It was around 60. It's still today trading, even though it's rallying today, below where the previous earnings were in March in the low 50s. And again, you have to take a look at the overall picture where we're headed into the second half of 2025. Is the Fed going to really lower rates three times, two times, maybe only once? And so obviously, if somebody's in a home and their mortgage rate is 5% or 4% or 6%, they'd have to be really motivated or have a reason to move and sell that house because they're going to get a mortgage rate, even with good credit, that could be 6.75, 6.5, what is even considered a good rate right now. So home builders definitely have taken a hit, and the market's strong. The market's in an uptrend, and these are nowhere near the highs. The previous high in KBH was around 88 and change, and it was last year, I think, in 2024.
Yeah, Mike, as we look here, we talk about revenues, margins, profits, less activity. That's the concern here, that some of those things will be hit, right?
I think that's right. I think on a fundamental level, it's really hard for home builders to work with 7% mortgage rates and increased competition from the pre-owned market at the same time. Over the last couple of years, we actually have had periods where home builders performed well, but that's when the pre-owned market was basically in quicksand and folks who owned homes weren't selling them. We've been starting to see that change for the last 12 to 18 months. We're seeing the pre-owned market start to heat up, the composition of inventory start to change in terms of the housing market, and high rates plus increased competition from existing homes is a tough recipe for home builders to succeed in.
Yeah, and I will tell you, I spoke to a guest today who said he had buys on D.R. Horton and Meritage. He also liked Lennar, but saying David Traynor of New Constructs, he had KB Home as his least favorite in the group. Do you have a favorite in the group, Mike?
No, not especially. I think the truth is, as long as this inventory dynamic, along with the higher interest rates persist, home builders are an underweight or a short with us. And on top of that, the labor market data is pretty clearly starting to deteriorate as well, which usually means slower real income growth. And as you see slower real income growth, that weighs on the housing market as well. You can either finance a home or you can buy it out of income. And when both financing is expensive and income growth is slowing, it's hard for home builders to outperform. And until the Fed dramatically changes its stance of monetary policy, we don't see that changing.
There's a concern that these homebuilder stocks really could fluctuate, Melissa, as we have the impact of tariffs, labor market shifts. Do you have a favorite in the group that you would buy on the dip?
No, not really. It's funny you mentioned tariffs. I forgot about tariffs. With everything that's been going on in the last 24 to 48 hours with Iran, everyone's forgotten about tariffs. But remember the 90-day pause. That's coming up in what, 2 weeks? So, I mean, there's definitely going to be tariffs, which is going to affect builders with increased products and things that they're buying. So that's going to affect prices. And then you have on top of that, the interest rate issue. So even if interest rates do drop twice this year, or even if they drop three times, which I don't think is going to happen, but even if they would, you're going to see increases in pricing because products are going to increase because there are going to be tariff deals that are made. I don't know if it's going to be as soon as President Trump would like them to be made, but people are going to pay more for things coming in from other countries, and we'll see how that shakes out in prices with housing.
Well, the market's showing resiliency once again. The Dow's up 200, the S&P 500's up over 6,000. So pretty amazing after what we saw back in April. A final thought here. Mike, do you have a favorite stock or a favorite something that you think is heading higher?
Favorite stock or favorite something? That's a good question. We're a little cautious on stocks right now. starting in April, our stance changed in terms of the economy from reflation to deflation. So in other words, we transitioned from expecting faster real growth and faster inflation to slower real growth and slower inflation. Now, that doesn't mean that stocks have to perform poorly. It is the worst economic regime for stocks by our work. Because we just expect a mild deflation or a non-recessionary growth slowdown is the way that we explain it. We think stocks probably trade a little bit higher. Our expectation is for kind of low single-digit annualized returns from here, but we think it's going to be choppy. So, we think stocks are okay, but we're not going to see a repeat of 2023 or 2024.
And then we also hear that the tariffs will be pushed back once again. I know July 8th and 9th is our sort of deadline date, but the word on the street is that many of those will be pushed back once again. Melissa Armo, Mike Singleton. Thank you, Melissa and Mike. Good to see you both. And good to see you, friends. Thanks for being with me here live on Schwab Network from the New York Stock Exchange. I'm Nicole Petalides. Thanks for being